Welcome to Tax Implications of COVID-19, 2020 Tax Filing, Payment, and Refund Deadlines, sponsored by the ABA section of Taxation. At this point, I am happy to introduce your moderator for today's program, Tom Greenaway. Tom, please go ahead.
Thank you, Phil. And we are joined on the program today by Mark Sommer, Jennifer Auchterlonie, and Annie Wurtzebach. So Mark is a practice group leader with Frost Brown Todd, LLC. He's located in Louisville, Kentucky. Jennifer is special counsel with the IRS Office of Chief Counsel's Procedure and Administration Division. She is located in Washington, D.C. Annie is an associate with DLA Piper. She is located in New York, New York. And I am a principal at KPMG, and I work out of Boston. So we're going to start here on slide 3 of the program, just to take you through the objectives of what we want to cover here on this panel. First, we're going to go through with Jen current IRS priorities, both from an administrative and a guidance perspective. Second, we're going to review updated federal tax filing and payment deadlines because there's been a huge amount of activity on that front over the past several weeks. Third, we're going to do a brief survey of federal refund opportunities and associated deadlines because that can be quite confusing, and it's a topic that all of our clients are focused on right now. And finally, we'll cover state and local changes associated with all of this. And if you thought the federal side was complicated, just wait for Mark and his presentation on the state and local piece. So shifting now to slide 4, I think all of us have been close watchers of the IRS website. We're used to a tax guidance process and I guess just the world of tax being relatively slow-paced. Like everything, this has changed over the past month, and the IRS and the attorneys in the Office of Chief Counsel have done a tremendous job adapting to the the pandemic and everything that it's thrown at all of us along the way. So the IRS is changing the way it operates and changing the way it gets out guidance and doing a terrific job with all of that. And I encourage everyone to check in to the IRS website on a regular basis because guidance and other news is being posted on basically a daily basis, if not more often. So just to recap what has happened here over the past little while, Congress has acted with lightning speed. There have been so far 3 different phases of congressional acts associated with this pandemic. Phase 1 was passed on March 6th, Phase 2 on March 18th, and finally Phase 3 on March 28th or 27th, I think. So again, huge appropriations and huge tax changes in the space of days and weeks. Coupled with the congressional action, of course, we've had both presidential national emergency declaration on March 13th, and that unlocks some procedural options for the IRS and Treasury that Jen will take us through, and some presidential disaster declarations, all of which are retroactive to January 20th. I bring those up because those are important for some of the loss provisions that we'll talk about later. And then finally, on the administrative side, the IRS has been incredibly busy and incredibly productive in terms of getting news out and information out to taxpayers and practitioners alike. This list may be stale even from yesterday, but at my last count, we had 8 IRS notices related to the coronavirus pandemic, 2 revenue procedures, dozens of FAQs that were put out by IRS, certainly more than a dozen Treasury and IRS press releases. So with that as background, I want to turn over to Jen Auchterlonie to take us through slide 6 and focus us on what's a priority for the IRS right now.
Okay, thanks, Tom. So obviously the economic impact payments are a huge priority. We have 150 million eligible taxpayers who will be automatically receiving an economic impact payment of up to $1,200 for individuals or $2,400 for married couples, and parents will also get $500 for each qualifying child. Taxpayers are eligible for the full amount of the payment if they have adjusted gross income of up to $75,000 for single taxpayers, $112,500 for head of household, and $150,000 for married filing joint. Above those levels, there is a phase out, and the payment phases out completely above $99,000 for single filers, $136,500 for head of household, and $198,000 for married filing joint. There are some eligibility requirements. For example, you do have to have a valid Social Security number to be eligible, and non-resident aliens are not eligible. The payments are underway. The IRS began issuing economic impact payments this past weekend, so they have begun to go out. The payments will be automatically direct deposited into taxpayers' bank accounts. For taxpayers who do not have bank accounts and who have traditionally received tax refunds via paper check, those taxpayers will receive their economic impact payment through the mail. Also, the IRS plans to mail a letter about the economic impact payment to a taxpayer's last known address within 15 days after the payment is issued. The letter will provide information on how the payment was made and how to report any failure to receive the payment. Unfortunately, taxpayers do need to be on the lookout for scams related to these economic impact payments. So please do remind your clients that the IRS will not call you, will not text you, will not email you, will not reach out to you on social media asking for personal or bank account information, even in connection with these economic impact payments. Also, do watch out for emails with attachments or links claiming to have special information about economic impact payments or refunds. In fact, just today, a few hours ago, we issued a press release in which the IRS and its Security Summit partners, which include state tax agencies, urge tax professionals to take additional security steps immediately to protect taxpayer data as more practitioners are teleworking and security risks increase with that. So I wanted to highlight that here. And I'll turn it over to Tom to talk about outreach.
Yeah, thank you, Jen. And this is a really important element of the project. So as Jen said, many millions of taxpayers will receive these benefits through a direct deposit, but there are still millions and millions of qualified U.S. residents who will not get that direct deposit. And as you can imagine, many people in those populations do not view the IRS as a friend. And so we really do need to have practitioners and members of the tax world, stakeholders at large, reaching out to those communities, to those people who may not be able to interact with the IRS digitally, to go on to this web portal that the IRS has just established and is going to go live this week. If we can help people to enter their Social Security numbers and their qualifying information, let's do that. I think each of us has a responsibility as not just tax practitioners, but basically, this is a matter of public service from my perspective, and I know this is the view of the ABA tax section leadership. So again, I think the ask that's coming out from the IRS commissioner directly, and I think it's a good one, is each of us should feel a sense of personal responsibility to help Congress and the administration deliver this benefit as widely as possible. It may not be sufficient to stabilize the economy, but it's certainly going to be hundreds of billions of dollars, and each of us can play a role in ensuring that money gets distributed to where it should go. So With that, Jen, let me turn it back to you to talk about the current filing season.
Sure. So as the slide notes there at the bottom, the current filing season is proceeding and refunds continue to go out. Through April 3rd of this year, taxpayers filed more than 97.4 million returns, and the IRS has paid out more than $213 billion in refunds. The April 3rd figures are the most recent figures that we have to share on this. These figures are down a bit from the same time last year. At the same time last year, the IRS had received 103 million individual income tax returns compared to 97 million this year, which is a difference of about 5.9%. Also, at the same time last year, the IRS had paid out about 221 billion in refunds compared to 213 billion this year, which is a difference of 3.5%. But I did look at our filing season statistics and noted that the filing season figures have actually been down a bit all season long. As of the end of the second full week of tax season, which was the week ending February 7th, 2020, the IRS had received 28.6 million individual income tax returns, and that compares with 28.7 million received by the same time in 2019, a drop of about 0.4%. In terms of refunds issued, by the end of the second full week of tax season this year, the IRS had paid out roughly $21.2 billion in refunds as compared to $22.2 billion at the same time last year, which is a drop of about 4.6%. The IRS urges taxpayers to file electronically through their tax preparer, through tax software, or through the IRS free file if at all possible. So far this year, more than 90% of taxpayers have filed electronically. Paper returns will be processed once the processing centers are able to reopen. And as is always the case every year, filing electronically along with using direct deposit is the fastest and most secure way to get your refund. If we turn to the next slide, this lists some of the processes and activities that the IRS has announced it has suspended at this time. With respect to taxpayer correspondence, the IRS is receiving and storing mail, but it is possible that correspondence sent to an IRS office may be returned to the taxpayer if that office is closed and no one is available to accept it, as I see on the first bullet point. I don't know if that's happening in many cases, as indicated on the slide, but it is something to be cognizant of. We are posting information about IRS operations on our website and updating it very frequently. So please do check irs.gov often for updates on what our operations are doing. On March 25th, the IRS issued a press release rolling out its People First initiative. That press release noted some of these suspensions that are listed here on the slide, although it also made clear that the IRS will continue to take steps where necessary to protect all applicable statutes of limitations. In instances where statute expirations might be jeopardized during this time, taxpayers are encouraged to cooperate in extending such statutes. But the IRS is also prepared and can issue notices of deficiency and pursue other similar actions to protect the interests of the government in preserving those statutes. Right now, a lot of taxpayers and practitioners I know are concerned with what is the best way to communicate with the IRS. And this is an issue that the IRS is aware of and is working on. Our Deputy Commissioner for Services and Enforcement, Sunita Lowe, issued a memo on this on March 27th, which addresses some of the issues involved, providing a temporary deviation from IRS procedures on the subject of electronic transmission and digital signatures on certain documents, like statute extensions and closing agreements. But this is something that the IRS is continuing to work to address. So please do stay tuned to irs.gov for more information on communicating with the service during this time. And then finally, there's a note at the bottom of the slide about the period between April 1 and July 15 being disregarded for some purposes. And this is going to be addressed coming up, I think, next in the presentation. But I just wanted to note that the period of time from making assessments has not been postponed to July 15th. Kind of looks like it has been on this, the way the slide is worded. So I think that's a typo in the slide, but we're going to get to that issue later in the presentation. I'll hand it off to whoever's covering the next slide.
Yeah, I
Thanks,
think we're
Jen.
going to Annie.
Yes, thank you. All right, so I'm going to talk about Notice 2020-23. Just for a bit of background, Section 7508 Cap A permits the IRS to extend a number of deadlines because of presidentially declared disasters. As we've discussed, following the President's March 13th emergency declaration in response to the COVID pandemic, the IRS provided relief pursuant to Section 7508 Cap A for certain income tax payment and filing deadlines. And the IRS did that in notices 2020-17, 2020-18, 2020-20, and then last week the IRS further amplified and expanded relief for taxpayers in Notice 2023. And Notice 2023 grants virtually all individuals, trusts, estates, corporations, partnerships, S-corps, and other taxpayers that ordinarily would have had a filing, payment, or other tax deadline between April 1, 2020 and July 15, 2020, a filing and payment postponement until July 15. And so this means that anyone can now wait until July 15 to file their 2019 federal income tax return and pay any income tax due. And so the notice also provides that the postponement applies to the second quarter estimated tax payments that would have been due on June 15, 2020, which 1 month before the extended due date for the first quarter payments. And the notice also postpones due dates for certain government acts and the application date for annual filing season program. Jennifer is going to talk a bit more about the postponement for government acts later on. And so the specified forms, if we go to the next slide, the specified forms and specified time-sensitive actions that are due between April 1, 2020 and July 15, 2020 are now automatically postponed until July 15. So you don't need to apply for an extension, and any taxpayer who would like an extension to file until October 15, 2020 has until July 15, 2020 to make that request. Some taxpayers may choose to e-file on or before April 15, 2020, except as Jen mentioned, paper filings are not recommended at this time. And additionally, any interest, penalties, and additions to tax will be disregarded during that time up until July 15, and then will begin accruing after that date. So relief is generally limited to federal income and gift tax returns and payments due between April 1 and July 15. If we go to the next slide, there's a list of the postponed filing deadlines, which include all series of tax forms due between April 1 and July 15, which are now due on July 15. Those include individual income tax returns, U.S. trust income tax returns, corporate tax returns, gift and GST tax returns, exempt orgs, net investment income tax, individual estate and trust, seat tax, and also on this list should be partnership returns for fiscal, if the partnership or S-corp return would be due between April 1 and July 15. It is also now postponed. So it does not include partnership or S-corp returns that were due on March 16th of this year, because the 15th was a Sunday. And so those have not been included, but if the fiscal year falls in that time, those are also postponed. deadlines for information returns that must be filed with income tax returns, like Forms 3520, 5471, 5472, 8621, 8858, 8865, and 8938 are also postponed. And if you have more questions, the FAQs and the Notice 2023, as well as RevProc 2018-58, specifically enumerate many more forms if you have specific questions about whether something is covered or not. FBARs are also automatically extended until October 15. And so those
And
are
if
just
I could interrupt
Yes,
just real briefly. One thing, this is Jennifer. One thing I wanted to note is Form 706 estate taxes have also been postponed. That's in the notice. And then in terms of the FAQ, right now we still have posted the FAQ that we put up for Notice 2020-18. But of course, that was more limited relief, so some of those answers aren't going to be useful to people now. So we do have a note at the top of that FAQ. You'll see if you look it up online, that these were written for 2020-18, and we are in the process of revising to account for Notice 2020-20 and Notice 2020-23. So my hope is that we will get those revised answers for you up soon, but they're not up yet. So the old ones are still up with sort of a caveat posted at the top.
Got it. Thanks, Jennifer. All right, and then so as far as postponed payment deadlines, payments and contributions originally due, again, between that same time period, between April 1 and July 15, are now due on July 15. And those payments would include balance due on 2019 income tax returns, 2019 payments with income tax extensions, estimated tax payments. As I mentioned before, that would include both the first and second quarter estimated tax payments, Section 965H installment payments, and BEAT payments, and as well as contributions to IRAs, qualified retirement plans, HSAs, and Archer MSAs. So with that said, I'm going to hand it back to Jennifer to discuss the specified time-sensitive actions that are outlined in the notice.
Okay, so this is the next slide here. Talks about some of the specified time-sensitive actions that are covered in the notice. So affected taxpayers are going to have until July 15 to perform these specified time-sensitive actions that are due to be performed currently either on or after April 1st and before July 15th. So I'll run through some of these and discuss them a little bit. The first one is, first bullet is filing a refund suit or filing a petition with the tax court or for review of a decision of the tax court. With respect to tax court petitions, I want to be clear that this includes any type of tax court petition. So it's not limited to petitions challenging deficiencies, for example. So this includes CDP appeals, innocent spouse cases, interest abatement cases, declaratory judgment cases concerning tax-exempt status or worker classification, any type of tax court petition. And the way it works is if that petition that you're wanting to file, if right now it's due on or after April 1st and before July 15th, that due date is postponed to July 15th. So you would need to file it by July 15th or on July 15th. The second bullet point is filing a claim for credit or refund of any tax. So one of the big ones this captures is it provides relief for taxpayers who haven't yet claimed refunds for their 2016 tax years because the time would be running out tomorrow to file that claim for refund. That has now been postponed to July 15th. But this provision is not limited to that situation. So this postponement includes any type of tax. So it's a claim for credit or refund of any tax Any tax means any tax. So it's not just claims for refund of income taxes. So, for example, this would include claims for refund of employment taxes, if that's something that you are working on. The next bullet point is any other time-sensitive act listed in Revenue Procedure 2018-58. And as the slide notes, there are more than 270 specific acts listed in that Rev Proc. The acts that can be postponed under Revenue Procedure 2018-58 really run the gamut. So there's sort of no better way to sort of understand it than to just encourage everyone to read it and get familiar with it, because it's just sort of a laundry list or a menu of items that can be postponed. So if you practice in a part of the country that tends toward natural disasters like hurricanes, floods, and fires, you might already be familiar with this revenue procedure because it is something that we draw upon in our standard disaster relief. But this is the first time that we're really rolling out disaster relief on a nationwide or even really a worldwide basis. So this revenue procedure might be new to some of you. It's organized by subject matter. So the different subjects include individual tax issues, corporate issues, employee benefit issues, estate and gift issues, exempt org issues, international issues, partnership and S Corp issues. So it's divided up that way, and then in each section it lists the acts that can be postponed with reference to whatever statute or regulation authorizes the act. So if any of those acts for your client is currently due to be performed on or after April 1 and before July 15, it is now postponed to July 15. So that would be the deadline for performing that act. Also, opportunity zone investment elections, those are provided for directly in the notice. They're not in the Rev Proc because they're very new. So those are specifically provided for in the notice. And then the next section covers the 30-day postponement for the IRS to complete certain time-sensitive actions. And the first thing I have to point out on the slide is there's actually a typo, unfortunately. There's a reference to Section 6510 C7. That should be Section 6501 C7. Which that code section provides a special rule for assessment when an amended return is filed within 60 days of the assessment statute running. So 6501 is what you want to read there. So this is a 30-day postponement in this section. It is not a postponement to July 15th, and it only applies with respect to certain taxpayers, those who are currently under exam or in appeals, and those who fit under the special rule provided in 6501 C7. And now I'll turn it over to whoever's next.
So Jen, that's me, and I apologize. That's my typo, and I know you had corrected that on an earlier draft, so my apologies for leaving that in there. Let's pause now. I'm going to talk a little bit about what is not in the notice, that is what is not postponed. But before we do, let me just try to capture and address some of the questions. Love, by the way, all the questions coming in from friends. We're getting dozens and dozens of them, and we're unfortunately probably not going to be able to address all of them. But just to reiterate a point that both Annie and Jen made, if you have a question about a particular form or a particular action that typically would need to be done between April 1st and July 15th, your best course of action is to look at the notice 2020-23, and also the revenue procedure, 2018-58. As Jen said, there are over 270 specified acts in there. Your best way to do it is just to pull up an electronic version and find, search for either the code section or the form that you're looking for. And that's going to answer a lot of your questions. There are some some exceptions to this rule that I'll get to, but I do want to be sure everyone has those tools at hand, because that'll help guide you through this process. Some other questions that are coming in around what is suspended. If your clients are getting collection notices, or if they have collection notices that were issued by IRS, again, reiterating an earlier slide, IRS has suspended automatic collection activity and suspended field collection activity. Outside, statute of limitations considerations, clients can rest assured that the IRS is not going to levy their bank accounts during this time. That was an assurance that came from the IRS commissioner. That's a major concern. Again, tax court petitions, all of those deadlines have been postponed. But again, go back to the notice, go back to the Rev Proc if you want to be sure about your concern.
Oh, Tom, if I could interrupt for just a moment.
Yeah.
So this is Jen again. I just wanted to point out also there is a hotline for COVID-19 disaster relief. The hotline number is in Notice 2020-23. The number is 202-317-5436. And we do have several P&A docket attorneys who are picking up the messages on that phone line and calling people back. So do feel free to reach out there. There's also a specific attorney in pass-throughs who volunteered to take calls for estate and gift issues, and that person is Daniel Guestpass, and his number is 202-317-6859. So we do have those two numbers, and I encourage people to reach out with questions.
Yeah, thank you, Jen. And again, just a huge thanks on behalf of everybody on the webcast and the tax practitioner community. We know that everybody in IRS and the Office of Chief Counsel have been working nights and weekends to get this guidance out and to get this information to us, and very much appreciate the access and the transparency, not to mention your participation on this webcast. Okay, so we've gone through in the first 13 slides what has been postponed. Now let's talk about what has not been postponed. A big one, for at least for the time being, is excise tax returns. So any tax that needs to be reported to the IRS on Form 720 is not yet postponed, and that covers a lot of excise taxes, from airline excise taxes to fuel to insurance and reinsurance. So any number of different excise tax returns that are filed with the IRS are still due on their original due date. A different bureau in the Treasury has suspended, or I should say delayed, the filing and payment due deadlines for excise taxes on wine, beer, distilled spirits, tobacco products, cigarette papers, firearms, and ammunition. But again, the general excise tax returns and payments that are due on Form 720 have not yet been postponed. And it's not quite clear yet whether or not they will be postponed, but for today they are not. Another very large category of taxes that have not been postponed across the board are payroll and employment tax filing and payment deadlines. So that's your Form 940, 941s, and that's a couple questions that we've got coming in. There are absolutely some changes and modifications to those rules, which we'll talk about at a very high level. But the big takeaway here is employment tax deposits, payments, and returns are still due. And then we've touched on this before already, but for the most part, information returns, most of which are due before April 1st, have not yet been or have not been extended, and it's unlikely that they will be extended. So we'll talk about each of these bullets in a little more detail on subsequent slides here.
Tom, if I can just interject, this is Jen. So we are I'm still tracking and maintaining a list of requests for additional relief. So various groups and individuals have sent in requests for additional relief, and that does include excise tax. So it's still an issue that we're working. In terms of payroll taxes, a lot of that, really is being taken care of with the CARES Act legislation, which I think we're going to be discussing. But we are still tracking a list of requests for additional relief, and if people have those requests that they want to make, they can send them in, and I will put them on the list.
Yeah, thank you, Jen. And I should also note that, of course, almost all the forms and payments that I can think of come with a reasonable cause exception to any sort of late payment or late filing penalty. And those rules, of course, are still with us. So even if a form or a payment has not been extended, if a taxpayer exercised ordinary business care and prudence under the circumstances, but was nevertheless unable to meet its federal tax obligation, then the reasonable cause rules and provisions of the code and the regulations should be able to give your client some comfort. Of course, that's not as comforting as the official postponements, but I think the general sense that we should all be getting from IRS and Treasury is that the IRS and Treasury are not looking to penalize and punish taxpayers right now. So if you exercise ordinary business care and prudence and just for any number of circumstances can't meet your obligations, I think in time any kind of penalty issue should be able to be resolved.
Yeah, this is Jen.
Okay, so
if I can just interrupt, definitely don't forget about reasonable cause, but also the services first time abate policy, which can also be available.
Yeah, that's great. I mean, many practitioners know about first time abate, but just to be clear, for those who do not, it's generally applicable for delinquency additions to tax on failure to file and failure to pay, for taxpayers who have no penalties assessed on that particular module, whatever that tax return is that you're talking about, for the 3 preceding periods. So that is to say, if you're a 1040 filer and you don't have any delinquency penalties on your account for the prior 3 years, the service will automatically waive penalties or additions to tax if you have a failure to file or a failure to pay. It's an across-the-board administrative waiver that's provided. It's been in the Internal Revenue Manual for a long time. And excellent point, Jen, to bring that up as well. Okay, so now dive into a little more detail on these 3 bullets on slide 14. The next slide, slide 15, talks about the deferrals for employment taxes and SECA. Oh, sorry, let's go back one here. So this was a huge provision in the CARES Act. A little bit of a sleeper provision. It wasn't given the headline news that some of the other provisions in the Phase 3 CARES Act got. But under Section 2302 of the CARES Act, payment is deferred for 100% of applicable employment taxes, which is a term of art, and 50% of self-employment tax paid by self-employed individuals, incurred during the payroll tax deferral period. So that's March, and I think this is another typo that I didn't pick up, Jen, March 27th to December 31st, 2020. So basically the rest of this calendar year, the CARES Act deferred payment for employment taxes and SECA. So those deferred balances are due 50% by the end of 2021 and 50% by the end of 2022. So it's, a long deferral period. And of course, the whole point of this is to inject additional liquidity into the economy. Again, this is a huge number. Applicable employment taxes are the employer's share, the 6.2% of Social Security tax that employers otherwise are responsible for paying in 2020. And just going off of the most recently published data in the IRS data book, employers and self-employed individuals paid over $1 trillion of these applicable employment taxes and SECA to the Treasury in FY18. So this is an enormous figure and an enormous benefit that's provided by Congress. As you can imagine, with legislation that happened as quickly as this did, there are some unanswered questions around both the implementation and the interpretation of this provision, and we're not going to get into any detail on those developments on this webcast, other than to note two. First, we've got a bullet here, the bottom bullet, that says the income tax deduction for applicable employment taxes is generally deferred until payment under the economic performance rules, unless it's paid within 8.5 months after the close of the tax year under the recurring item exception. And so for many large corporate taxpayers with tax capacity, that is the ability to use those deductions, it's essentially an economic wash as to whether or not they want to defer payment for a year or two, because by deferring payment, they're going to also defer the income tax benefit. And when you just do the math, it's roughly equivalent on a steady state with respect to interest rates. So that's a major consideration. It remains to be seen whether or not IRS and Treasury will issue any guidance modifying the economic performance rules with respect to this provision, but I think for now it is most practitioners' current understanding that the economic performance rules limit the income tax deduction associated with these employment taxes to payment. So that's one item. Another issue that has come up, that actually has come up in the questions here on our webcast as well, is what happens when this deferral is paired up with the SBA loans that are part of another provision of the CARES Act that we're not going to talk about on this webcast, and the SBA loan is subsequently forgiven. That is, the taxpayer has the right to turn that loan into essentially a grant. And I know, Jen, you had picked this up in your FAQs in terms of what taxpayers can do or must do if they want to take both the loan and the deferral. Do you want to talk to that item?
Oh, so that was in the, I think, the FAQs put out by EEE, which I do not have handy. Did I send it to you?
Yeah, you did. And I think that in a nutshell, a lot of taxpayers were asking, if I want to take that loan, but I don't know yet whether or not I'm going to ask for the loan to be forgiven, can I also defer my employment taxes? And if so, what happens if I ask for that loan to be forgiven? So I think the answer is you can do both, but and it sort of remains to be seen how quickly those deferrals are going to come due on the loan forgiveness. So that's, I think, a place to watch. We're not going to go into any huge detail here, but just be careful. There are some really complicated interplays between these massive provisions that Congress put in the CARES Act. So Jen, I don't know if you want to say anything more on that.
Nope, you got it.
Okay, so moving on from slide 15 to slide 16, I noted that even though the employment tax deadlines haven't changed, there is some relief in the form of Notice 20/2022 for failure to deposit. So that is if, and generally there's some very quick deposit obligations on payroll tax liabilities, either the next day or at the most within a week or two. But the IRS is administratively waiving additions to tax for failure to deposit taxes for qualified sick leave wages and qualified family leave wages as mandated by Phase 2, and qualified health plan expenses allocable to those wages, as well as certain employers subject to a full or partial closure order due to COVID-19 or experiencing statutorily specified decline in business pursuant to, as outlined in the CARES Act. So those are, again, are technical terms that all of us are grappling with at this point, but the IRS has said to the extent you're affected by any of those provisions as outlined in the CARES Act, the IRS will waive penalties for failure to deposit taxes. This is a big category now, moving on to slide 17, for information returns that were not postponed. So this slide lays out a series of information returns that are generally due, as I said, before April 1st, and here we've got the due dates. The IRS has not postponed the calendar year information returns set out here on this table. We do have an asterisk here on Form 3520A. There is a way to basically file a substitute 3520A by the postponed due date for 3520, and that should protect those taxpayers to which it applies. Also want to note that Form 1042S is, and the associated withholding and payment that goes along with that, is eligible for a 30-day extension. So there are a lot of 1042S filers who put in for that 30-day extension, which is coming due, of course, on April 15th, which is coming due tomorrow. The IRS, again, has not extended that deadline as of yet. And Jen, I don't know if you want to put any color on that point.
No, it would just be still has not provided any relief on that.
And finally, circling back to a point that that Annie made in her presentation, again, calendar year partnership returns and S-corp returns, the original due date was March 15th, and that continues to be the case. There has been no relief there. However, if you have a fiscal year partnership or a fiscal year S-corp with its due date, either extended or original, coming due in the postponement period set out in Notice 2020-23, then those information returns are postponed. So a little bit complicated, but I just wanted to cover that again. Okay, moving on to slide 18. This is an introductory slide. Again, we're not going to go into any amount of detail on the substantive provisions here, but many of us are working closely with our clients and investigating some of these. We call them new levers for taxpayers and practitioners to pull to generate tax refunds. Of course, this is a matter of policy. The Congress, the administration, the Treasury, and IRS are all encouraging taxpayers to generate liquidity in the form of cash tax refunds. And we're seeing already the IRS responding to that policy direction in making these refund opportunities as easy as possible under the circumstances to follow through on. So I don't have to explain to anyone on this call that preparing and processing these refund claims will be challenging for practitioners and the IRS alike. All of us are working from home. All of us are working from with limited resources and limited connectivity, and that's absolutely true for IRS, which has a massive processing obligation at the best of times and is struggling, as we all are under these circumstances. But having said that, again, the IRS is responding quickly here, and this is news that came out yesterday, that beginning on April 17th, so in a couple of days, 3 days from now, taxpayers may fax in certain tentative carryback applications to the IRS with a 100-page limit. And anyone who's prepared these things in the past knows that 100 pages may not do the trick. But Form 1045, which is applicable for individuals, there's the fax number 844-249-6237, and Form 1139 for corporations, tentative carrybacks, is you're going to want to fax those into 844-249-6236. And this is huge because a lot of our clients have been eagerly awaiting an opportunity to file, and now we have it. The IRS also said in this announcement that the forms will be processed on a first-in, first-out basis. Again, you want to be patient with the IRS, and just some word of advice here. You want to make sure that you dot your I's and you cross your T's. There are some FAQs and some additional information on the IRS website about how to modify the instructions on your own until the IRS can get a chance to do it as appropriate for the CARES Act. This procedure is only going to be allowed for claims that are provided for under Section 2303 and 2305 of the CARES Act. So generally, that's minimum tax credit refunds for corporations, and for tax years ending in 2018, 19, and 20 for NOL carrybacks. So that's a limitation, but again, it's going to open up a huge opportunity for thousands, if not millions, of taxpayers. So want to be sure you alert your clients to this opportunity. Moving on to slide 19, we've got a list, a very short list here of some of the sources of losses and other opportunities to generate a refund. And Mark, I want to loop you in here because Section 165I allows taxpayers to accelerate and deduct a year early disaster casualty losses. And I know you in particular have some clients who are affected by this sort of provision.
Thanks, Tom. Yeah, absolutely. The agriculture community in particular practices via Schedule F predominantly, and we've had a lot of inquiries on the 165 casualty issue for claims related to agriculture, inability to take product to market or spoliation, and that's could be a big cash benefit to the farming or the agriculture community overall. So we suspect there'll be a lot of challenges raised by getting those kinds of refund opportunities out, given working remotely. But practitioners should be aware of that opportunity.
Yeah, and just agriculture is a terrific example, but it's not limited to agriculture. As Jen hinted to earlier in the program, these disaster declarations are usually typical for only some of us in the country and localized. The big difference here, of course, is the president has declared essentially the entire country a disaster area. So any kind of 165 loss with a nexus to the COVID pandemic really should be investigated for the possibility of claiming that 165 loss and making that 165I election take the loss a year earlier than incurred. So let's just say a crop loss in March of 2020 under a 165I election, you can take that loss on your 2019 return and generate a refund faster, which is, of course, the whole point, to increase cash flow at a time when people really need it. Accounting method changes, of course, are always an opportunity to accelerate deductions and defer income inclusions to build up a loss. And then there are the specific CARES Act provisions, again, that we won't go into any detail here, but that are absolutely going to be driving some refund opportunities. There's some procedural rules that came into play here, Section 2303 2304 and 2305 open up carryback opportunities that had been eliminated in the 2017 Tax Reform Act, but also some substantive changes to the 163J rules, and the technical fix around qualified improvement property are going to generate some refund opportunities in prior years. So with that, let me quickly touch on this Rev Proc 2020-23. And this, again, is a terrific piece of guidance from IRS that allows partnerships to circumvent, or to take an alternative approach, I should say, to the general rules that that would ordinarily defer any kind of favorable benefit into 2020. And instead, now partnerships can file an amended return for tax years beginning in 2018 or 2019 in order to send out amended K-1s to their partners that would allow partners to file refund claims faster than they otherwise would, or at least faster than they would otherwise benefit from these changes. So again, not going to go into huge detail there, but there's quite a lot in the Rev Proc, and if it applies to you, I encourage you to read it closely. This notice on slide 21 is also very important. I think it came as a surprise to many practitioners and many taxpayers, but again, it just shows you how much IRS and Treasury are working to open up all of these levers and make them available to taxpayers. In a nutshell, the time for filing a tentative carryback application had already expired with respect to 2018 and 2019 tax returns. There's a limited window in which to file that tentative carryback application, and it had already expired. With this notice, the IRS has opened that window back up and has allowed taxpayers until the end of June to file these 1045s or 1139s, again, to get that tentative carryback adjustment in and get that tentative cash refund out. So this is huge, and this links back to those fax numbers that I mentioned earlier. That's going to open up a lot more refund opportunities for taxpayers. So terrific piece of work here from IRS and Treasury.
Tom, if I can just interrupt briefly. There is on irs.gov, if you go to irs.gov/form 1139, you will find the temporary procedures to fax the forms in. So there's a link there. If you go to irs.gov/form 1139.
Thanks, Jen. And we do have the authorities and some materials in the slide deck at the end, so you'd be able to use your these materials to help guide you as well. But again, as I said at the top, the IRS website is probably going to be the best place to look. So slide 22 is meant to be a takeaway for this audience. We don't have time to go through it in any amount of detail, and I thank everybody who helped contribute to this slide. There's a huge amount of data there. These rules are complicated. These rules are a combination of provisions of the CARES Act and underlying provisions in the Internal Revenue Code and recently issued guidance from IRS and Treasury. So all very complicated, but as you can see, the due dates are not all the same. And I would hate to have anyone on this call go away thinking that they're going to file a refund claim and miss the window to do so. So do spend some time with this and use it as your guide, depending on the path that you're looking to generate your income tax refunds. Okay, so with that, we're at the top of the hour, and I want to make sure we give enough time to Mark to take us through the state and local slides. And Mark, do you want to bridge us over here from this table to the state and local guidance?
Excellent. Thank you, Tom, and appreciate all the great dialogue so far. I'll take you back to a comment Tom made in the opening of our webinar today, where he talked about SALT complexity vis-a-vis the extensions. That's not hyperbole, as you'll learn here in a moment, and I'll give you some examples. The level and difference of extensions, waivers, grants, for lack of a better term, accommodations, which are coming out of the state and local governments, it truly could be seen as the wild, wild west. We're not going to get into micro issues in jurisdictions because it would simply take hours and hours. We're going to talk about big picture topics. So as you'll see on slide 23, nearly all states have announced some extension of time file and pay taxes, or have offered penalty relief should there be a late or shorted payment, and certainly interest relief in many instances as well. Most of these extensions relate to income taxes, which are annual taxes and quarterly estimates as a part thereof. And most extensions do not relate to any kind of an excise type tax, local and state imposed sales and use tax being the most predominant excise tax in state and local taxation. There have been changes granted throughout many states in the country. Illinois specifically was one of the earliest to do so, with respect to deferred remittance of sales and use tax collections, effectively akin to the CARES Act employer FICA piece deferral, but certainly not as generous in terms of the time period of the deferral. I think the longest deferral that I've seen is 90 days in any particular jurisdiction. The audience today needs to keep in mind that June 30 is the typical fiscal year end for states, and deferring 2 months worth of sales and use tax payments, forward 90 days or 120 days could literally break the budget, given the significant reliance upon sales and use tax receipts in these various states. So if you have clients in that area, retailers and small businesses in particular, you need to take a look at the granular rules that have been rolled out in sales and use tax and other excise taxes such as gas tax, perhaps liquor tax, tobacco tax, and the like. We are first quarter moving into now in second quarter. That's property tax time on a state and local perspective, and many property tax filings have been extended in some states. More are coming out literally every day. And then it's also real property tax valuation season, where businesses and individual taxpayers can challenge the valuation of their real estate. That's generally an annual type endeavor, and it's generally somewhere between month 2 to month 5 of the calendar year, and so those are being extended as well. Speaking specifically as to virtually all states, quote unquote, there's far too many to detail, too many changes. I want to refer the audience to the best compilation that I have found to date. The most inclusive and the most explanatory is from our accountant colleagues, and that's found at the AICPA website, www.aicpa.org. That is, as of an hour ago, a 398-page PDF file with explanatory text and dozens and dozens and dozens of links to source documents. And a theme you'll hear from me today is don't believe the rhetoric, don't believe the headline. We need to read the details, just as Tom and company have encouraged the attendees today to do on the federal side. We need to keep that in mind. But 398 pages of detailed analysis with respect to what has been extended, what has not been extended, whether it was statutory, regulatory, or administrative discretion, what FAQs are out there, and what legislation, if any, causing statutory changes has in fact been implemented. Consistent with the Internal Revenue Service and Treasury extension, slide 24 will confirm that almost all states, to the extent they have extended for primarily income tax matters, corporate or individual, those have been extended through July 15th, the due dates. Of course, traditional 6-month extensions are still possible. There's been no change in that regard. Payment remittance has likewise been extended through July 15th. There are questions as to whether or not the June 15th estimated payments for the 2020 tax year, whether those have been extended at the state level, and I think that more information on that will be rolling out as time passes. One of the open issues, which is prevalent all across the country, is what's really covered by the income tax language when you see a headline or a blast, which we've all no doubt received hundreds of in the last 2 weeks. What's brought within the scope or the grasp of that? Does it cover trust and estates that file income tax returns? Does it cover bank taxes, which are typically not traditional corporate income tax filings? Capital stock taxes, maybe a balance sheet type tax, or a franchise tax. There are open questions in many, many jurisdictions, and so I urge the attendees to take a look at whatever state you're talking about. Maybe you start with the AICPA website and drill into it, but there's a lot of open issues. One other area to be considered by everyone is it's oftentimes unclear in the administrative pronouncement how it impacts fiscal year filers. We can infer as to how it would and when it does, but sometimes it's unclear. In the haste to get the relief out, which is great policy, sometimes it's raising just as many questions as it is resolving. The extended due dates all remain the same as we talked about earlier. Slide 25 will highlight some of the more granular examples. And no change in due date. New Jersey is highlighted in our slides. That's now old news. Overnight, New Jersey had some pronouncement that the governor was going to sign some legislation today, I believe, which would extend tax payment deadlines in a manner consistent with most of New Jersey's sister states. You'll see a little bit of detail on extensions or not of 2020 estimated payment due dates: Arizona, Arkansas, the District of Columbia, Hawaii, Illinois, Iowa, Louisiana, Minnesota, Montana, Oregon. For the reasons I've articulated previously, why wouldn't they do that? Well, it could just be fiscal stability. The state and local jurisdictions have to balance their budget, as far as I know, according to the Constitution of every state in the country. And so they need the cash. An extension of some of these payments to June 15th or certainly April 15th, that may very well negatively impact the cash receipts for the general fund in these respective states, and they've made a policy decision not to cash flow that in order to protect the fisc of their respective state. There's some non-conforming extension dates out there. Mississippi, the May 15th. Virginia has got a difference between filing and payment dates of 30 days. Idaho, a June 15th extension. Hawaii, July 20th. Iowa, July 31st. Each state is different. I guess as we walk through some of these more granular examples of differences between the jurisdictions, it becomes more readily apparent why there might be a 398-page document out there trying to detail on this. Interest in many jurisdictions will be due on deferred payments. You see North Carolina and Virginia highlighted on slide 25. There are still more that are out there. My home state of Kentucky is one of those states, but we're optimistic that that'll actually be changed today or tomorrow, the last two legislative days of our annual General Assembly. That in mind. One of the questions, I'll go back to slide 25. One of the questions is, what do you do about interest? If you get an extension on the payment of the tax principal, how do you calculate the interest? How do you remit the interest? There are many schools of thought how to handle that. Many states have compound interest on interest. There are many states that do not have compound interest on interest, and therefore some instances a best practice may be when you make the tax principal payment, make it and wait for a billing to come in on the interest. That's one tactic to make sure you get the right interest charged. Others might want to be more proactive in that regard. I want to go over a couple final points here. It's important to read all the guidance, as I've indicated several times today, but I'm going to use my home state of Kentucky as probably, I think, the best example that I could find, certainly, of what it is, and you really need to read it. I'll read this. This is bill text passed 2 weeks ago. The Department of Revenue shall adhere to any declarations or changes in tax filing and payment requirements provided by the U.S. Treasury or the IRS, and provide the same to taxpayers for comparable tax filing and payment requirements. And then it goes on with some includings. So effectively, anything that the service does, anything that the Treasury does to make changes to due dates, whether they be filing, whether they be tolling of statutes, whether they be petitions to the tax court, right? It raises the question with Kentucky, this type of example, Kentucky example, it raises the question, has all of that also been adopted at the state level? Most states don't have this kind of breadth or scope in their extension. Most states have simply issued almost FAQs or administrative discretionary orders extending payment or filing dates, in most states, both. So I do urge you to focus on these issues later on if the issues do come up. I'll conclude with issues of tolling of statute of limitations. Generally, the extensions that have been granted by the respective state and local taxing authorities have a forward-looking paradigm and not a backward impact. But for the filing date for the 2019 return, nothing else is really going backwards. However, look at the Kentucky language I just gave you. And then I cited another COVID-related piece of legislation, this one out of Ohio 2 weeks ago, where they formally told the statute of limitations on, among other things, refund claims and refund claim lawsuits associated with Ohio tax. I would urge practitioners to consider protective filings, protective claims with respect to state and local taxes. But we need to keep that in mind that in some jurisdictions there is no mechanism by which to make a quote-unquote protective filing. Last slide, and then I think we're going to go to some questions, is state penalty abatement. Similar to the comments made earlier, similar to the pronouncements by IRS and Treasury, people trying to do the right thing are going to likely fall into the reasonable cause exception to imposition of penalties or after the fact abatement of penalties previously asserted. In general, at the state and local level, emails and casual conversation with tax advisors generally doesn't constitute proof of trying to do the right thing. But I do raise the question of whether or not in this environment, informal communications, contemporaneous and timely with consideration of action or inaction by a taxpayer, I think that may very well be very important in trying to demonstrate that you, a taxpayer, with your assistance as an advisor, was trying to do the right thing. That's what I think all taxpayers are trying to do. Certainly, the agencies, by granting these extensions, are trying to do that and do right by the taxpayer. So, Tom?
Thank you, Mark. Yeah, I think that's good advice across the board, obviously from a federal and a state and local perspective as well. So that concludes the presentation portion of the webcast. As I think we suspected, we got a huge number of questions. We've got over 100 questions in the queue, and I'll encourage my fellow panelists to look through those questions. I know a question that was asked a couple times, Jen, so I just ask you to dig your phone numbers back up again. If you could provide the hotline numbers, and as well as the attorney who's offered to take questions on estate and gift issues, maybe I'll come back to you in a minute.
I've got
let me
it.
just try to. Okay, great. Yeah, go ahead.
Yeah, so you can call the COVID-19 Disaster Relief Hotline at 202-317-5436 for questions on all of the disaster relief notices. And if you have specific questions regarding estate, gift, trust, and generation skipping transfer tax issues related to these same notices, you can contact Daniel Guestpass at 202-317-6859. And the way you spell his last name is Gespass. I don't actually know how to pronounce it.
Yeah, so thanks, Jen. And again, that phone number, the hotline number is at the back of the materials, so you can scroll forward and find that as well. Let me go through a couple of questions that have been repeated, so I just want to make sure we hit those. So number one, a question that a lot of people ask is, do I have to do anything to benefit from the postponement to July 15th? And the answer to that is no. A taxpayer does not have to file an extension today or tomorrow to benefit from this postponement to the extent the notice applies to them. Another question that came up around a couple times over estimated taxes, at least for, let's just take calendar year taxpayers, individuals who had a Q1 estimated tax payment due tomorrow, and another one that was going to be due June 15th. Both of those, and Jen, you can correct me here if I'm wrong, but both of those estimated tax payments are now due on July 15th. So that is, there's not going to be a reordering of them or anything else. They're just going to stack up, and both come due on July 15th. And subject, of course, to the reservation that was in the notice that further guidance and subsequent developments may change that. But for the time being, those estimated tax payments are now going to be due July 15th, and interest and penalties will accrue after that date if they're not paid in.
That's correct, Tom. And so people can just make a single payment on July 15 to cover both the April 15 payment and the June payment.
And so there are a number of questions around, specific acts, time-sensitive acts. And again, we'd encourage all of you to go to Revenue Procedure 2018-58 and study it closely. One question that came up a couple of times is, what do we do with the 1031 rules and if there's an extension of time that's provided in the Rev Proc that is longer than that would take us to a point that's later than July 15th, for instance. And for instance, if you look at Section 17 of Rev Proc 2018-58, it offers some guidance around 1031 exchanges. And the revenue procedure, as you expect, says that you basically have until the later of 120 days or whatever the deadline is put out in the notice. So if you have a 1031 transaction that you have a 120-day extension under the Rev Proc that extends later than July 15th, my assumption just reading the RevProc, is you have that 120 days to fulfill your obligations under the 1031. It's the later of those rules. But again, that's just a great example of why you need to read all the guidance really closely.
Tom, I'll just say that we have been getting a lot of questions about 1031 exchanges. So we are working on FAQs that will help explain sort of what the relief is there. Just to let people know, we hear all of your questions, and we're working on a more of an explanation for you.
Let me pick up another question that actually bears on it gives me a chance to go back to our table on slide 22. So thank you for friends for already closely reading this, and this question does come in from a friend on the estimated tax overpayments, the 2019 estimated tax overpayments. It's actually a correction, which is good. So corporations and not individuals have the ability to get a refund of estimated tax as long as they file that form 4466, usually before the original due date of the return. So that form 4466 for corporations is now due on or before July 15th, 2020, as set out in the table. But of course, individuals have 3 years to file a refund claim, as we talked about. So that July 15th date is the earliest due date, and it only applies to corporations. But it does give me another opportunity to talk about the advice we've been giving our clients. Again, the form 4466 is a manually processed form. It's a paper file return form that usually gets processed by hand in the service center. The service centers are effectively closed for paper processing right now. The mail is stacking up, I think, as Deputy Commissioner Sunita Lowe said on a webcast yesterday, in trailers. It will be attended to once the service centers are able to get back up and running. But in terms of giving helpful advice to our clients, filing a form 4466 that's just going to sit in a trailer for weeks, if not months, is not helpful advice. So again, I just go back to something that Jen said at the beginning of the webcast. If you possibly can, prepare and file an e-file, a tax return for 2019 is probably going to be your best and quickest path to get a refund out of 2019. E-file returns are still being processed, and that's true on the corporate side as well as the individual side. So some of these mechanisms that used to work in the past probably should be reconsidered in light of any kind of e-filing opportunity. So Annie, do you want to take a question or two?
Sure.
So we had a question that came in on what does the notice do, if anything, to Court of Claims deadlines?
Sure. Well, per the notice, the reference to the 7508 Cap A regulations that are specifically referenced in the notice says that bringing a suit upon a claim for credit or refund of any tax is also included in that postponement. So filing a petition in the Court of Federal Claims is included, as well as the same reference is made in Notice 2018-58. It's not specifically clear with respect to additional filings or other filings that might be made in the Court of Federal Claims, as the question suggests. And so I'm not sure if Jen might have a little more insight on other filings other than petitions.
So I think it's talking about refund suits. So I'm not clear on what other suits people would want to file in the Court of Federal Claims, unless there were still filing suits over the renewable energy grants in lieu of credits. I don't know if those suits are still being filed, but those are not refund suits, so potentially those would not be captured in this.
Yeah, so of course, once you're subject to the jurisdiction of a court, you're subject to the court's rules, and so you want to make sure you clear any kind of deadlines or any kind of delays with that court. So just let me come back to one more batch of questions that, again, just illustrate the importance of going to the guidance and reading it closely. We had some questions around Form 1042, which we discussed has up until now not been extended. The deadline has not been extended for filing Forms 1042 or 1042S. However, the RevProc the 2018 RevProc does grant relief for 1446 withholding, so ECI withholding, which is similar but different than 1042 reporting for withholding tax, is extended. So there's absolutely some nuance here and some differences. So again, want to make sure you go read the guidance closely.
Tom, I just wanted to point out for people who want to pull up copies of Revenue Procedure 2018-58 online. To me, the most reader-friendly version is the version that appears in the PDF version of Internal Revenue Bulletin 2018-50. That was published on December 10, 2018. That's the IRB where this revenue procedure is. So if you pull up the PDF of that Internal Revenue Bulletin, again, it's IRB number 2018-50, then you can extract out the pages from that PDF that just cover Revenue Procedure 2018-58, and it's only 29 pages, and it's formatted, to me, very reader-friendly. So if you do a Google search and you find the version that was early dropped to the media, that PDF is like over 100 pages and not super reader-friendly. So I recommend the PDF of the version that appeared in the IRB.
Now you tell me, Jen. I've been struggling with the drop version for 2 weeks.
Yeah, don't read that. Read the other one. It's only 29 pages. It's got boxes. It's very well formatted, easier to read.
All right, so there you go. There's some really good practical advice from someone who's been laboring in these fields for longer than any of us, and then I mean that over the past 2 weeks. So again, thank you, Jen, for dedicating so much of your time helping us prepare and present this presentation, especially when you're so busy with other obligations inside Office of Chief Counsel. Thank you, Mark, Sommer, for taking us through the state and local rules, which, as you point out, are geometrically more difficult than the federal rules. And thank you, Annie, for taking us through the notice and the associated guidance here. But most of all, thank you to the audience. We have a huge audience here. We got a very energetic set of questions. Very much appreciate all the government attendees on the presentation. I know the ABA tax section has been talking with IRS officials about doing more teaming and more joint training, and I'm glad we're doing this. I'm not glad about the circumstances, but we want to continue to collaborate with people in IRS, with people in Treasury, and people across the government. So with that, let me close on the slide that shows the upcoming ABA CARES Act webcasts. Some of these are still in development, so we're not quite sure when the timing will be, but ask you to stay tuned and tune in for the rest of the programming that we hope to do around the CARES Act. We're going to do an employer-focused presentation that's going to dive into greater details around the employment tax deferrals and credits that are available. And then we'll take a deeper dive on the business provisions and for both corporate and pass-throughs. And of course, we're never going to forget about individuals and families. So with that, let me turn it back over to Phil to close us out, and thank you all again.
All right. On behalf of the American Bar Association and the ABA section of taxation, thank you for participating in this program. To learn more about our sponsors, visit the ABA website at americanbar.org. Thank you, and please click on the evaluation link that you are seeing come up here.